Most traders do not lose because they exit too early. They lose because they overstay. The market rewards decisiveness, not hope. Big money is made by selling strength, not by praying for more. Example, when price rallies sharply on diminishing demand after a clear markup, the professional distributes quietly, while the public, intoxicated by recent profits, holds on and hands back weeks of gains in a single reaction. The first and most costly mistake made by the untrained trader is the belief that profits increase with patience alone. In truth, the market does not reward waiting, it rewards correct action taken at the proper time. Hope has no standing on the tape. The professional understands that profits are harvested when demand is present, not when it has already been satisfied. Every advance reaches a point where effort begins to exceed result. Price continues upward, yet each rally requires greater volume to achieve less progress. This is not strength, it is exhaustion masked as optimism. At this stage, the public is most confident, interpreting higher prices as confirmation, while the informed operator recognizes a far different condition distribution. It is here, in the presence of eager buyers, that the professional sells. Strength is defined not by emotion but by behavior. Wide spreads on heavy volume, rapid advances, and enthusiastic participation signal opportunity not to enter, but to exit. Liquidity exists only when others are willing to take the opposite side. The trader who waits for weakness to appear before acting finds no market for his position, for fear replaces enthusiasm, and prices decline faster than decisions can be made. Hope enters when analysis leaves. Once a trader abandons objective signs and replaces them with expectation, the trade is no longer managed, it is endured. The market offers no mercy at such moments. A rally that fails to follow through after apparent strength is a clear warning. The professional does not argue with this message, he responds to it. He understands that markets turn not when logic demands, but when imbalance is complete. Selling into strength requires discipline and preparation. The exit is planned at the time of entry based on structure, range, and the character of the move. Resistance zones are not suggestions, they are areas of professional activity. When price approaches these levels with climactic behavior, the trader acts, regardless of personal bias or recent success. The public trader waits for certainty. The professional accepts probability. He knows that exact tops are not required to secure large profits. What is required is consistency, exiting when risk begins to outweigh reward. By doing so repeatedly, he preserves both capital and confidence. The greatest gains are not lost because the market reverses unexpectedly. They are surrendered because the trader refused to act while conditions were favorable. Profits that are not protected are merely temporary. The market does not owe continuation, only opportunity. To win big, one must abandon the desire for just a little more. The professional measures success not by how long he stayed, but by how well he executed. In this, selling strength is not an act of fear, it is the mark of mastery. Indecision is not neutrality in the market, it is a position. And it is one that the market exploits relentlessly. Nowhere is this more evident than near the end of a sustained advance. At this stage, price has already fulfilled its purpose. The intelligent trader senses completion, while the untrained mind hesitates, suspended between fear of missing more profit and fear of giving back what has already been earned. The final phase of a move is governed by emotion rather than logic. Price spreads widen, volume expands, and participation increases rapidly. This is commonly mistaken for strength. In reality, it is excess and imbalance created by urgent public buying. Professionals do not hesitate here, they act with precision. Indecision at such moments is costly because conditions deteriorate faster than resolve can form. The public trader waits for clarity. He seeks confirmation that the trend has ended before acting. But confirmation always arrives after opportunity has passed. By the time weakness is obvious, prices have already moved far enough to erase the advantage that once existed. The market does not reverse slowly at the top. It turns abruptly, catching hesitation off guard. Indecision often disguises itself as discipline. The trader tells himself he is letting winners run, when in truth he has relinquished control. A position without a defined exit is not confidence, it is neglect. The professional never confuses patience with inaction. He understands that patience is exercised during preparation and waiting for opportunity, not during execution. As an advance matures, risk increases even if price continues higher. Each additional point gained is purchased with greater exposure. The market demands decisiveness because the margin for error narrows. When a rally shows signs of strain, failed follow-through, inability to hold new highs, or rapid reactions on light, selling, the warning has been issued. Delay at this point is interpreted by the market as consent to loss. The composite operator thrives on this hesitation. Distribution occurs not because professionals are uncertain, but because the public is. Indecision provides the liquidity necessary for transfer of ownership. Those who hesitate become the willing buyers at unfavorable prices, and later the forced sellers when fear replaces confidence. Decisive action near the end of a move does not require predicting the exact top. It requires recognizing the shift in character. The professional responds to behavior, not to opinion. He exits while the market still offers favorable terms, understanding that preservation of profit is important as its creation. The market punishes indecision because it cannot tolerate uncertainty. It rewards those who act when conditions demand it. In mastering this principle, the trader learns that the greatest danger is not being wrong, but waiting too long to be right. The market rarely ends a major advance in a quiet or orderly manner. Instead, it exhausts itself through excess. The skilled trader understands that the signs of termination are visible long before the final high is recognized by the crowd. Those who wait for obvious confirmation surrender their advantage to those who study behavior. A buying climax is not defined by price alone, but by the relationship between effort and result. Volume expands dramatically, spreads widen, and progress becomes erratic. Each upward thrust requires increasing effort, yet yields diminishing reward. This is the market's confession of fatigue. To the untrained eye, such activity appears bullish. To the professional, it is a warning that demand is being consumed. Weakness often emerges quietly after the climax. Price may hold near the highs, giving the impression of strength, while internal conditions deteriorate. Rallies fail to follow through, reactions become sharper. Support that once held effortlessly now requires defense. These subtle changes are ignored by the public, who judge strength by price level alone, not by the quality of movement. The professional trader does not wait for the breakdown. He understands that by the time weakness is obvious, distribution has already occurred. The market's purpose is to transfer ownership from strong hands to weak hands at the highest possible prices. This transfer is completed while optimism remains high, not after it disappears. Climactic action often coincides with news, excitement, or widespread conviction. These events do not cause the top, they accompany it. They provide the emotional fuel required to attract late buyers. The trader who relies on headlines is always late. The trader who reads the tape is early. A key error made by many is the belief that price must immediately collapse after a climax. Often it does not. The market may drift, retest highs, or move sideways, reinforcing false confidence. This is not continuation, it is preparation. During this period, the professional finishes his work while the public grows more committed. Weakness reveals itself through inability. Inability to rally strongly. Inability to sustain new highs. Inability to attract demand without increased effort. These are not dramatic events, but they are decisive. The professional respects them because he understands that markets change character before they change direction. Exiting during this phase requires independence of thought. It demands action where others are still hopeful. The trader who waits to be proven right will be proven wrong by price. Those who act on early signs preserve gains and maintain control. The top is obvious only in hindsight. In real time, it is disguised by activity and emotion. Mastery lies in recognizing climax and weakness as processes, not points. The trader who understands this truth does not seek perfection, he seeks preservation. In doing so, he exits as a professional, not as a victim. Every operation in the market must be conducted as a campaign, not as a single act of speculation. The untrained trader enters with enthusiasm but manages the position with neglect. He focuses entirely on the outcome. ignoring the process that determines it. When profits are lost after being earned, it is rarely due to bad analysis. It is the result of poor campaign management. A campaign begins with a clear objective. The professional defines the probable extent of the move before committing capital. He studies the cause, the structure, and the character of the market. From this, he establishes zones of potential resistance where risk will increase and reward will diminish. These areas are not surprises, they are anticipated. Holding too long occurs when the trader refuses to adjust his position as conditions change. Early in a move, patience is rewarded. Later, it becomes dangerous. As price advances, exposure increases while opportunity decreases. The market demands a reduction of risk, not blind persistence. To ignore this is to confuse conviction with stubbornness. The professional manages size as carefully as direction. As objectives are approached, he scales out, locking in profits while allowing the market to continue if it can. This is not weakness, it is control. A position that remains fully exposed near resistance is a position that has been abandoned by discipline. Many traders believe that exiting partially reduces profit potential. In reality, it preserves it. Large winners are not built by one perfect exit, but by a series of intelligent decisions. The trader who insists on selling everything at the top usually sells nothing at the right time. Campaign management also requires attention to market character. If rallies become labored, reactions sharper, and progress uneven, the campaign must be adjusted. The professional responds to these changes without emotion. He does not argue with the market, he negotiates with it. Failure to manage a campaign properly often stems from emotional attachment. Profits create confidence, and confidence breeds complacency. The trader begins to identify with the position, measuring success by how long he stays rather than how well he executes. This is the moment when discipline is most needed and most often absent. The market does not reward loyalty, it rewards adaptability. A campaign that was correct at the beginning can become dangerous at the end. The professional accepts this reality and acts accordingly. Holding too long is not a mistake of analysis, but of management. It is the refusal to recognize that the market environment has shifted. Those who master campaign management understand that exiting well is as important as entering well. In this mastery lies consistency, longevity, and the ability to win big not once, but repeatedly. The pursuit of the perfect exit has ruined more traders than poor analysis ever could. The market does not reward perfection, it rewards process. The professional understands that success is not measured by capturing the final point of a move, but by executing sound decisions repeatedly under similar conditions. Big wins are the cumulative result of many well-managed campaigns, not a single heroic trade. The untrained trader seeks validation through precision. He wants to sell the exact top to prove his insight and timing. In doing so, he exposes himself to unnecessary risk. The market is under no obligation to satisfy such ambition. It moves according to supply and demand, not personal expectation. When traders hold positions in search of the ideal exit, they often forfeit the very profits they worked to obtain. Repetition is the foundation of professional success. Each campaign follows the same principles. Identify accumulation, participate during markup, reduce exposure as distribution appears, and exit before weakness becomes apparent. None of these steps requires perfection. They require discipline. When applied consistently, the results compound over time. The professional judges exits by quality, not by exactness. Was the position reduced when risk increased? Were profits protected as objectives were met? Was the trader acting on market behavior rather than hope? These questions matter far more than whether the final high was captured. One well-executed exit will not define a career. 100 properly managed exits will. The trader who accepts this truth frees himself from emotional pressure. He no longer needs the market to do anything extraordinary. He needs only to respond correctly to what it offers. Markets are uncertain by nature. This uncertainty cannot be eliminated, but it can be managed. By exiting systematically during favorable conditions, the trader transforms randomness into consistency. Losses become manageable, gains become repeatable, and confidence becomes grounded in experience rather than luck. The illusion of the perfect exit often arises from hindsight. Charts make tops appear obvious after the fact, but in real time they are obscured by noise and emotion. The professional does not compete with hindsight, he competes with probability. Winning big is not about bold predictions or flawless timing. It is about survival through cycles and growth through repetition. The trader who masters exits understands that capital preserved is opportunity retained. By focusing on consistent execution rather than isolated brilliance, he aligns himself with the true rhythm of the market. In this lies the final lesson. The market does not crown those who guess best once, it rewards those who act well again and again. The market does not measure a trader by how confidently he enters, but by how intelligently he exits. Every principle discussed leads to a single truth: profits are made available by the market, but they are taken only by discipline. The impulse to hold too long is not a flaw of knowledge, it is a failure of execution at the moment when execution matters most. The professional trader learns to act when strength is present, to decide why others hesitate, and to recognize weakness before it becomes obvious. He manages each position as a campaign, reducing risk as reward diminishes, and he accepts that consistency outweighs perfection. In doing so, he removes emotion from decision-making and replaces it with method. Winning big is not about capturing the final move, predicting the exact top, or proving insight to the crowd. It is about preserving capital, protecting profits, and repeating sound behavior across many operations. The market will always tempt traders with one more push higher. Those who resist that temptation endure. Those who master it prosper. In the end, success belongs not to the boldest holder, but to the most disciplined executor. The trader who understands when to exit has already learned how to win.